Hello, and welcome back to the channel. My name is Zach Collins, and this is Financial Education. Today, what we're going to be examining is superannuation. Now, every Australian has a super account, but the majority don't actually know anything about it. So I thought it would be good to go and give a brief overview, as there's so much to go into, and I don't actually have the time to do a full debrief. So we'll just go through the basics today. So because a lot of people have an account and don't actually know what it is, that's where I'll start. What is superannuation? Superannuation, or super for short, is what we call our retirement savings account. You may have heard of terms like 401k or IRA or TFSA or even KiwiSaver. Now, these are all foreign retirement accounts. They're all similar, but they all have different characteristics. And that is why knowing how super specifically acts is very important, because knowing all the ins and outs can make a big difference to your retirement savings. Because super is specifically designed to be used for retirement, it means that you can't touch this money until you reach a few conditions. Now, those conditions are either you're over age 65. If you're over age 65, you can do whatever you want with that money. You can start an account-based pension. You can withdraw lump sums. You can leave it as is. Once you're over 65, there's no restrictions on the money. You can treat it like it's another bank account. It's all yours. If you are over preservation age, which, look, for the majority of people watching this, that will be age 60. You can access your super only on the additional condition that you are retired. So if let's say you're age 61, for example, you decide to leave your job. Now you can access your super. If you're 61, but you're still working, you've met the condition of over 60, but you have not met the retirement condition. So you can't access your super balance. If you meet both these conditions, it's the same as if you're over age 65. Once you've met those, you have full access and full control over your super account. Now, there is a little caveat of like a TTR pension. I'm not going to go into that in this video. If you're under age 60, you can't access your super for any reason. Look, I say any reason, but there are a few situations where you can. They're very niche and will impact less than 1% of the population. I'm not going to go into it today. Just understand that in general, if you're under age 60, you can't touch your super. If you do want to know more about, what these conditions where you can access before age 60, I'd recommend checking out the ATO website. So how does super actually work? Now, think of it like an ordinary investment account. There's a range of different types that you can go with. That can be either an industry super fund, a retail super fund, or a self-managed super fund. They will all invest your money differently, but they all have to abide by the exact same laws. So what are the differences? An industry super fund tends to be run for the benefit of the members of a specific industry. So that can be something like a fund run for healthcare workers, for retail workers, hospitality workers, etc., etc. Now, there are a ton of different funds, so make sure you check them out. So retail funds are funds that have been set up to make a profit. Now, these retail funds tend to be run by big banks, or they're the platforms where you use a financial advisor to select your investments. A self-managed fund is basically exactly what it sounds like. You, specifically, are managing the investments. So this tends to be the most expensive type of fund, as you're going to pay for auditing and compliance costs. And, it can be a few $1,000s. So I think the average super fund is around about $150,000 to $200,000. So let's say it's about $5,000 in fees. That makes it about 3% of your balance in fees. So that really cuts into the returns. So for small balances, it tends not to be the best option. So how do super funds generate a return? They do this by investing your money. As I said just before, with a self-managed super fund, you have full control. You invest it in whatever asset class you want and have any asset allocation. There are some very strict laws around how you can do this. So you do need to make sure that before you do jump in as a trust of your own fund, that you do your own research first. Retail funds tend to have a broad range of funds to choose from. If you have a financial advisor, they will be picking what you're invested in. But if not, you should be able to call up the super fund and they'll give you a PDS with a rundown of what investments they offer. Now, as a general rule, they have a range of both active and passive fund managers. This can be like diversified funds. They can have single market funds, which only invest in Australian shares or only invest in international shares. They'll have some bond funds. They'll have cash funds and property funds. You get the idea. An industry fund is fairly similar to a retail fund, but will have significantly less options to choose from. So generally speaking, this can range from about 5 to about 20 options of investments, whereas a retail fund could have over 100. When you open an account with an industry fund, they will invest your money into a default investment option unless you choose to change it. Now you can easily see the difference in performance of the different default funds if you do a quick Google of My Super comparison. Now these default funds tend to have a risk rating around about the 70 to 90%. So this means that 70 to 90% of your money is invested in risk or growth assets. Now these could be things like stocks or property. The remainder of this will be invested, so about 10 to 30%, we're invested in defensive assets. So that's stuff like cash or bonds. Now, you should be able to find quite easily what the asset allocation is for your specific default fund on your super fund's website. Okay, so now that we've looked at the limits of accessing your super and how it's invested, what makes it so good? The simple answer to this is the tax benefits. I've got a video coming out soon where I'll go through different tax brackets. But with super, it's essentially a tax advantaged account. So what this means is that you're taxed less putting money into super than if you were to pay that tax personally. Let's use an example. So let's say you make $70,000 a year plus super guarantee, SG. So SG is what the employer is contributing to your super for your retirement. Now, currently, they have to contribute 11%. Come the 1st of July, it'll be 11.5%, and then a year later, it'll be 12%. And it'll stay at 12%. At least that's what the legislation says at the moment. So if you make $70,000 plus $7,700 in super contributions, you personally pay tax on $70,000. But then there's another $7,700 going straight into your super account, and this pays a flat tax of 15%. Now, this 15% will be lower than your marginal tax rate. That's basically where the main benefit is. So this $7,700 less the tax that you pay, this will get invested and will grow over time. So income that this investment will generate, that's also taxed at 15%, and capital gains will be taxed at either 10% or 15%. If you got paid this amount personally, so not only will the $7,700 be taxed higher, but let's say you invest this money, the income that this will generate will also be taxed in your marginal tax rate. The capital gains will also be taxed higher. So the more tax you pay basically means the less money overall gets invested in the market, and also means the less your portfolio will grow over time and will reduce your portfolio balance, in the future when you plan to retire. So is there a way we can actually take more advantage of the lower tax rate? Yes, there is. So if you contribute money to super via a salary sacrifice or as a personal contribution, and then fill out a notice of intent form to claim a tax deduction. You can then turn part of your salary into super contributions. So let's use that same example I had before. A person on $70,000 a year. Let's say they were to salary sacrifice $10,000 into super. This means that now, personally, they're only being taxed on is as if they'd earned $60,000. And they've got $17,700 going into super, which is taxed at a lower rate. So does paying less tax on your investment sound appealing? I mean, it kind of does to me. And that is why I love super. Before you think of how great it is, you do need to bear two very important things in mind when contributing extra money to super. The first is that there is a cap. You can't just chuck all your income into the super and get a tax benefit. So including the amount of money that your employer is putting in, the most that can go into super in any year and get the concessional 15% tax rate is currently $27,500. Now that will slowly increase over time with indexation, but currently $27,500 is the cap. The second thing you need to know is that once money's in super, you can't get it back out. That $10,000 you put in, that's now locked in until you either reach the preservation age I mentioned before of 60 and retire, or you reach age 65. Look, there's so much more I can say about super. This is just a very brief video. Let me know in the comments below if you want me to do a second, because there's so many stuff I'd love to talk about. Hopefully I've been able to give you a better understanding, and if you've got any more questions, please feel free to drop a comment below. I'll answer it if I can. Thank you so much for watching, and I'll see you on the next one.